If you've ever thought about the legacy you'll leave behind, you've probably asked yourself one massive question.
For so many of us, families, business owners all across the UK, this is the big worry, isn't it? Well, today, we're going to dive into a really powerful answer to that exact question. And this whole discussion is brought to you by the experts at My Tax Accountant. They're going to help us pull back the curtain on one of the most effective tools in estate planning, the Life Interest Trust.
So here's our roadmap. We'll kick off with the basics, then get into the nitty-gritty of the 3 key taxes you need to know about. After that, we'll look at some really smart planning strategies, walk through a real-world case study, and finally show you how to get expert help. Sound good? Let's jump in.
Okay, so first things first, what on earth is a life interest trust? Let's break it down, nice and simple. Think of it like this. You're basically splitting an asset's benefits in two. One person, who we call the life tenant, gets the income from it or maybe gets to live in a property for their entire life. Then, after they pass away, the actual asset itself, the house, the investment portfolio, goes to someone else, who we call the remaindermen. It's a brilliant way to provide for someone you love right now while making sure that asset is protected for the next generation. And to really get your head around it, you just need to know the 4 main characters in this story. You've got the settler, that's the person who sets the whole thing up, the trustee, they're the managers looking after the assets, the life tenant, who we just mentioned, benefits during their lifetime, and finally, the remainder man, who gets the asset in the end. Keeping these 4 roles straight is super helpful because the tax rules can hit each one of them differently. You know, a real-life example makes this so much clearer. Let's meet Doreen. She's 70, lives in Bristol. Her late husband set up a trust with a rental flat in it. So now Doreen is the life tenant, and that rental income gives her financial security. Meanwhile, her kids are the remainder men. They have peace of mind knowing that one day that valuable property will be theirs. See, it's a simple, elegant solution that looks after everybody.
All right, let's get into the part that everyone wants to know about, the tax. And we're talking specifically about the 2025-26 tax year. Now, I know this can feel like a total maze, but don't worry. We're going to break down the 3 big taxes you absolutely have to understand.
So first up is income tax. This is usually the one you'll deal with most often. Any income the trust makes, from rent, savings, whatever, it all has to be declared. But the million-dollar question is, who actually pays the tax bill? Is it the trust itself or the person who gets the money?
Now, here's a really important number for you. £500. For trusts with a small amount of income, this is a tax-free allowance. But, and this is a huge but, if the income goes over by even £1, tax is due on the whole lot. It's a classic tripwire you've got to watch out for.
So, when the trust does have to pay tax, the trustees use these flat rates, 20% for most income like rent, and a slightly lower 8.75% for dividends. But here's the clever part. If the life tenant, the person getting the income, is a non-taxpayer or just a basic rate taxpayer, they can often claim some or all of that tax back from HMRC. They just need a special form from the trustees called an R185. It's a great little tax-saving opportunity.
Okay, on to our second tax, capital gains tax, or CGT. This one kicks in when the trust sells something that's gone up in value, like a property or some shares. And you really have to be on your toes here, because the rules for trusts are a lot tougher than they are for individuals. And get this, the annual tax-free allowance for a trust is just £1,500. That is literally half of what an individual gets. So, as you can imagine, planning when and how to sell any assets is absolutely crucial.
Now for a pro tip, and honestly this is one of the most powerful benefits of these trusts. When the life tenant passes away, the value of the assets gets a reset. It's called a CGT uplift. What it means is that all the historic growth is completely wiped clean for tax purposes. It's like hitting a giant reset button, and it can be a massive, massive tax saver for your kids.
And that brings us to the big one, inheritance tax, or IHT. This is without a doubt the trickiest area. The rules here are incredibly sensitive to when the trust was created and how it was set up. And believe me, getting this part wrong can be a very expensive mistake.
Just look at the difference here. It's night and day. If you set up a trust in your will, it's usually super tax efficient. No horrible entry charges, no 10 yearly tax bills. But if you set up a similar trust while you're still alive, it can get hit with a pretty brutal tax regime. We're talking a 20% charge up front, plus ongoing fees. It just goes to show with trusts, timing really is everything.
Right, so now that we've got a handle on the rules of the game, let's talk about how to play it smart.
How can we use this knowledge to our advantage and find the most efficient path for our family's wealth?
Any professional advisor worth their salt will walk you through a clear process like this one. It all starts with your goals. Then you move on to choosing the right assets, and this is key, especially ones that might get special tax reliefs. They'll make sure the legal paperwork is flexible enough to handle future tax changes, that you use every exemption you can, and, critically, that you get the trust properly registered with HMRC so you don't get hit with any nasty fines.
And here's a did you know for you. If you're a business owner, this is a game changer. There's something called Business Property Relief, or BPR. For certain business assets, it can reduce the inheritance tax bill all the way down to zero, 100% relief. Think about Sanjay, who owns a bustling cafe in London. Putting his business into the right kind of trust using BPR could literally save his family hundreds of thousands of pounds.
There is one thing, but let's see how this all works in practice. We're going to look at a real case handled by the team at My Tax Accountant. This really shows you the pounds and pence difference that getting expert advice can make.
So, let me introduce you to Rena. Her late husband left her a substantial trust worth about 1.4 million pounds, which included his business. But with all that came a real tangle of tax issues: income tax, potential capital gains, a huge IIT liability looming. And on top of it all, there were compliance rules that she just had no idea about. She was, understandably, feeling pretty overwhelmed.
And just look at this transformation. The before picture is pretty scary. The family had overpaid tax, they were at risk of a £5,000 fine, and staring down the barrel of a potential IHT bill of nearly £500,000. But then look at the after. My tax accountant stepped in, got them a full tax refund, got the trust registered to avoid the fine, and completely wiped out that massive IHT bill. It's a huge swing from serious financial risk to total peace of mind.
Let's break down how they did it. That 8,000 pounds of income tax, they reclaimed it simply by spotting that Rena herself was a non-taxpayer. That potential 480,000 pounds inheritance tax bill, gone, because they correctly applied business property relief to the business assets, and that $5,000 fine, avoided by getting the trust properly registered. Every single one of those wins was a direct result of proactive, expert planning.
So, what's the grand total of all those savings? A staggering 488,600 pounds. And that is not just a number on a spreadsheet. That is real financial security for Regina and her family, protecting the business her husband had worked so hard to build. The Chutery family story just proves a really vital point. Yes, these tax rules are complicated, but having the right person in your corner, guiding you through it, makes all the difference in the world.
So, if anything we've talked about today has struck a chord, if it's got you thinking about your own situation and how you can best protect your family's future, then the next logical step is to get some advice that's tailored specifically to you.
The team at My Tax Accountant is really to help you figure out your own situation with that same level of expertise. They offer a free initial chat, no strings attached, just to discuss your circumstances. You can call or WhatsApp them on 07854 255 375, or just drop them an email. All the details are right there for you.
Thank you so much for joining me for this look into life interest trusts. And hey, make sure you subscribe to the My Tax Accountant channel on YouTube. That way you'll stay up to date with more expert guides on how to protect and grow your family's wealth.